Welcome back. You're with us here on Editors Roundtable. Well, let's shift focus now to the new age companies and what they are doing. By the way, Friday's session saw big gains across the board for these new age companies. Is performance improving? Is guidance improving? Nimesh is standing by on the big ball with all of the details. Nimesh, over to you.
Well, while all the platform companies are facing, supply overhang, because we all know that the lock-ins are opening up in this month. But, one must not lose the sight on the operational performance of these companies. Look at the calendar first. If you look at the calendar in this week and next week, Nykaa opened up for the lock-in opened up on 8th and 9th. And on 10th, we saw a 4 crore share block, which is around 1% equity. On 10th, we saw Fino Bank and PB Fintech opening up the lockup. And today, we saw a big block, 3% equity change hands in PB Fintech, which is almost, which is 3% of the company's equity. Next week, we have Paytm and Delivery, both Paytm on 14th or 15th and Delivery on the 19th, where the IPO opens up. So, if you look at the performance of all these platform companies, Y2D or this year, maybe from the highs, these stocks are down anywhere between 50 to 75%. That's the kind of wealth erosion we've seen. Almost 50% of the wealth has been eroded in these companies in 2022. But the important point to watch out for is that the performance have started improving for most of these companies, and that was visible in Q2. So let's go with the first stock, which is Nykaa. If you look at Nykaa, this week, after the lock-in got over and some block, the stock is up 18-20%. But look at the performance. The gross margins has improved to 45% versus 42% in YOY in Q2. And management is quite confident that 200 to 250 basis points of margins is sustainable. So that's Nykaa. Again, there was an interesting upgrade from BofA Securities this week, and they've upgraded the stock to a buy with an adjusted target price of 311 on Nykaa. Look at the other stock, which is PB Fintech. Now, even if you look at PB Fintech, there has been a strong performance in Q2. The revenues are up 27% versus the street estimations, and the contribution is also much better than what the street was expecting, up 63%. The adjusted EBITDA loss is half of what the street was expecting. So even there has been an operational performance which has improved for PB Fintech. The management is quite confident that the burn rate on the new initiatives will go below 200 crores. And by 2024 April, they are looking to return 1,500 crores of cash to the shareholders. The market cap of this company is just 17,000 crores. So that's an important figure if you go by the management. Now look at Paytm. Even that stock is down 52% this year, but the EBITDA loss of Paytm has narrowed again for the second consecutive quarter and has improved by 40% in this quarter. That is in Q2. In fact, the adjusted EBITDA break, and management is quite confident that the adjusted EBITDA break-even is possible and will happen by September 2023. So they are on track to have an EBITDA break-even by September 2023. Look at Zomato now. That stock is up 10. In fact, today, the stock was up 13%. In the Q2, profitability has been improving despite the steady growth. And the key surprise was the food delivery contribution margin has gone up to 4.5% versus just 2.8% in Q1. So there has been a clear operational outperformance in Zomato as well in second quarter. So, again, that's the whole point, that while there is supply overhang in all these stocks, but the key is that the operational performance is changing, and that's something to watch out for. That's the basic analysis. While fundamentals are improving, there is a short-term supply overhang in all these platform companies.
Okay, Nimesh. In fact, let's continue with the topic. Good markets mean IPOs make a comeback. And Rima has actually done some interesting study and has got some fascinating data for us. Rima, tell us.
Well, the primary market action was very dull. In fact, in June and July, there were no IPOs which hit the market. In August, September and October, we just had about fundraise from the IPOs to the tune of about 1,200, 1,300 crores. Some small ones like Traxon Technology or Sirma SGS. These were the kinds of company that listed. Come November, with the markets now almost at all-time high levels, the valuations picking up, risk appetite back in the market, we've seen a rush of IPOs. Last week, there were 4 IPOs which raised money. This week itself, we had 4 IPOs which raised money. So totally, in the first half of November, 8 IPOs have hit the market, and they've pretty much raised close to about 10,000 crore rupees. This would take the 2022 fundraise to close to about 54,000 crore rupees. This is according to data from Prime Database. Now, this would still be much lower than what we had last year. Last year, primary markets were red hot, and the overall fundraise was close to about 1.2 lakh crore rupees. But right now, things appear to be picking up. up. Another important, indicator from at least the November IPOs is that the money which is being raised is not going for growth capital or capex. Now, if you look at the November fundraise, which is close to about 10,000 crore rupees, 65% of that money is actually an offer for sale, where existing promoters are bringing their stake down, or some of the investors are, again, reducing their stake or exiting, like BKG or 5-Star Fusion. These were purely offer for sales. Or even in Medanta, almost 70-75% was an offer for sale. So a chunk of it, 65%, is actually an offer for sale. In the balance 35%, which is fresh money which is being raised, almost 40% has been used by companies to reduce debt. So it's good that, debt is coming down. Debt reduction is always a positive. But the fact that companies right now at least are not raising money for growth is also a very strong signal from a market point of view.
So, Rima, in short, what you're saying is the bankers are busy with FPOs, with IPOs.
Year-end, right? Year-end pressure.
Year-end bonuses as well for them, right? So, I guess it's good time for them.
Bankers are busy, which means Nimesh is busy.
Nimesh is busy, exactly. Okay,
Gives us something to talk.
Let's discuss this further then. We are now joined by Giri, Head of Research Division at IIFL. Giri, thanks a lot for joining us. The big talking point was on the kind of IT rally that we had and whether things have turned. What would be your view?
Not exactly, because there are 2-3 things to note here. One, when the Fed raises rates, there is the final intent is to cool inflation down, and that will happen when consumption comes down. And in the US, the consumption spending is quite a lot linked to the stock market. And if the markets rally, there is all likelihood that spending will stay reasonably strong. And I don't see how that will help bring inflation down. So it's a bit of a circularity. So the Fed has to raise rates, the markets have to break, then probably inflation will fall on a durable basis. But if a rally like this happens, like what happened in the US yesterday, and if everything goes up, including commodities, then inflation will probably be a little bit more stubborn. So in terms of expecting the Fed to go easy on rate hikes, we haven't seen the last bit. That's number one. And number two, in the steady state, the way we see it, real 10-year yields are a reasonably reliable indicator. And they've been traditionally in the 1% zone. And in the US, they went as low down as -6%. They've come up to about -4% after yesterday's move, -3.8%. But that's still quite a long way below where it used to be and where it must have ultimately reached. So I think it's too early to say that, in fact, it's impossible to say that we won't see a large speed breaker confront the US economy markets, and the IT stocks are linked to the US economy. And I think I would rather prefer stocks in the domestic growth space rather than IT.
Giri, we are coming to the fag end of this earnings season as well. How are earnings looking to you, and what have they done to the full year estimates? What has Q2 done to your full year estimates?
Yeah, I think I've seen a number of sectors suffer downgrades to the FY24 numbers. FY23 is a bit volatile because only half the year is left. So looking at FY24, it's a bit hard to see where there have been very significant upgrades. I can see PSU banks, I can see financial services, 1 or 2 odd sectors, but otherwise it's generally across the board downgrades of between 0.5% to 3%, and some sectors even more than that. So I would think that it's not very surprising that downgrades are happening. People are pulling their estimates down because we've not really invested enough for growth. And globally there is monetary tightening happening, and some spillover effect will be there in the Indian economy also.
Thank you very much for outlining that. With that, it's a wrap on this edition of Editors Roundtable from the entire team. Thank you for watching. Have a good weekend.